ever wish you could just hit a fast forward button on all the research.
Yeah, like get straight to the point.
Exactly. Skip the waiting and get the core insights on something complex. Well, that's what we're aiming for today. We're doing a deep dive into Adobe Inc. That's ticker symbol ADBE.
And our source material for this, it's pretty specific. It's this detailed internal investment memo. It performed what it calls an enduring quality analysis of Adobe.
Right. Think of it like you're getting a peek inside how someone really dug into this company. So this is your deep dive into that specific source material. Our mission here is to pull out the most important bits, the key nuggets of knowledge and insight from this analysis,
Right.
helping you understand what it highlights as truly essential about Adobe's business. Its competitive side, the management, the financials, and where it might be heading.
According to the memo, yeah.
Okay, so let's unpack this analysis, starting right at the beginning. The core business. How does Adobe actually make its money, according to this memo?
Well, the memo describes a model it's remarkably simple in a way, but incredibly powerful. It's all built around providing, mission-critical software for digital content creation and management. But the single biggest thing, the real pivot point for the business, that started around 2013.
Okay.
When they made that shift, the memo calls it courageous and highly successful, moving from selling old-school software licenses
Right, the boxes.
to a subscription model, software as a service, SaaS.
The famous cloud pivot. That was a huge deal, wasn't it? I remember some pushback from users back then.
But absolutely. A fundamental re-architecture, the memo says. And, well, it worked. It completely transformed Adobe into this predictable recurring revenue machine.
How much recurring?
Today, over 92% of their revenue comes from those ongoing subscriptions.
Right.
That single shift. It's really the bedrock of their modern financial story.
Wow. So where's all that recurring money coming from? What are the main engines, segment-wise?
Okay, so the memo breaks it down into two main parts. The biggest, what it calls the heart of the business, is digital media.
Okay.
That's making up about 73% of the total revenue. And inside digital media, you have their two most famous clouds.
Which are?
First, a creative cloud. It's the global standard for creative pros.
Photoshop, Premiere Pro, all
Exactly. Photoshop for images, Illustrator for vector graphics, Premiere Pro for video, After Effects for motion graphics, the whole suite.
Right.
They sell access through, tiered subscriptions, monthly, annual. The memo points out Creative Cloud alone generated, let's see, a massive $7.16 billion in 2022.
Just Creative Cloud. Wow.
Yeah. These are really the tools the pros feel they have to use.
Okay. And the other cloud within digital media.
That's the document cloud. This whole thing is built around the PDF format, which, remember, Adobe actually invented.
Oh, yeah, right.
So products here are things like Adobe Acrobat for creating and editing PDFs, and Adobe Sign for e-signatures. It's really positioned as a core productivity suite for businesses and individuals.
And that brings in?
It added another $1.69 billion in subscription revenue in 2022.
Okay, so digital media is the big one, with creative and document clouds. What's the other major segment then?
That's digital experience. This segment is more focused on the enterprise market.
Okay.
It provides tools for things like marketing automation, website analytics, advertising tech, e-commerce platforms.
And some of this came from buying other companies, right? Like Magento, Mercado.
Exactly. The memo notes much of this capability was built through strategic acquisitions over the years. Magento for commerce, Mercado for marketing automation are prime examples.
And the revenue contribution there.
According to the memo, digital experience contributed about $4.01 billion in subscription revenue in 2022. Got it. So, powerful software suites, creation, documents, enterprise marketing, all driven by subscriptions. What's the big economic advantage here? Why is this model so good for them, according to the memo?
This is where the leverage really kicks in. The memo highlights the inherently fixed cost nature of building and maintaining these big software platforms, meaning developing and updating Photoshop or Premiere Pro. That requires significant upfront investment, R&D, engineering.
Sure, big costs.
Right. But here's the critical point the memo makes. The cost to add one more subscriber to that existing platform. It's practically zero.
Okay, I see where this is going. The magic words, operating leverage.
Exactly. So once that initial fixed investment is covered, every new dollar of subscription revenue flows through with very, very little additional cost.
Which explains the margins.
That's why the memo points to Adobe's truly exceptional margins. consistently north of 88% gross margins and over 35% operating margins. The subscription model is it's designed to be a profit-generating engine once you hit scale. And the memo seems pretty confident about this model lasting, too. It uses the word endurance.
Yeah, very much so. It calls the model strikingly intelligible, and its endurance highly probable for like the next 1 to 2 decades.
Why so confident?
The basic thesis is simple. The demand for digital content creation, for managing digital documents, it isn't going away. If anything, it's growing. Adobe provides the essential picks and shovels for that whole digital economy.
All right.
And think about it, when Photoshop becomes a verb or PDF is just a standard noun everyone understands, that shows an incredible level of market penetration, real stickiness.
That's a good point. And there was something specific about education mentioned. How does that tie into the endurance story?
Yes. This is a really critical, kind of subtle point from the memo. Adobe strategically embeds its products deep within the global education system.
How so?
Think universities, design schools, film programs. They overwhelmingly teach using Creative Cloud, often at discounted rates for students.
So graduates come out?
Exactly. They enter the workforce already fluent, already skilled in Adobe tools. Employers, naturally, want talent who can hit the ground running and collaborate easily. So they'd standardize on Adobe too.
It's a loop.
It creates this powerful, self-reinforcing loop. It basically cements Creative Cloud status as the mandatory industry default for each new generation of professionals.
So that 2013 pivot, it was even smarter than just changing the pricing model.
Precisely.
Right.
The memo views it as foundational. Yes, it lowered the upfront cost, which helped combat piracy and expanded the market to students, hobbyists, freelancers.
Right.
But crucially, it created that direct, ongoing relationship with the customer. It made customer retention the absolute core driver of value for the company.
Okay, that makes sense.
So building on that profitable model, the memo then really digs into Adobe's economic moat, the fortress protecting its business from competitors.
Right, the moat. How does the memo describe the main wall of this fortress?
The number one moat factor identified is extremely high switching costs.
Switching costs. Explain that.
For millions of professional users, designers, video editors, marketers. Adobe software isn't just a tool. It's the absolute core infrastructure of how they work. Their skills, their workflows, their files, everything is tied to it.
Okay. What else strengthens that moat, according to the analysis?
2 other big advantages are highlighted. First, network effects.
Network effects. Yeah. Like, the more people use it, the better it gets.
Exactly. And it stems largely from the universal adoption of their proprietary file formats. Think about the PSD file for Photoshop, AI for Illustrator, the PDF itself.
Right. Everyone uses them.
If you're a designer, you have to be able to work with these formats to collaborate with clients, printers, other designers, because everyone else uses them. So the more users, the stronger the network, the harder it is for anyone else to break in.
Okay, network effects. What else?
And then there are the intangible assets. This includes just sheer global brand recognition, Photoshop, Acrobat. They're household names, basically synonymous with what they do. Plus, their vast portfolio of patents and proprietary code, that's incredibly difficult and expensive for any competitor to try and replicate.
The memo uses a really good real-world example to make these switching costs clear, right?
Yes, it does. It paints this picture of a professional video editor. Let's walk through it.
Okay.
So this editor probably learned their craft on Premiere Pro and After Effects back in school. Likely using a discounted student subscription from Adobe.
Makes sense.
They spend years, thousands of hours, building muscle memory, mastering shortcuts, developing workflows within that specific software ecosystem. They build their entire portfolio, archiving projects in Adobe's formats.
Okay.
Then they get hired by a studio. And guess what? That studio is almost certainly standardized on Creative Cloud because, well, everyone else is, and they need seamless collaboration. Now, imagine that editor trying to switch to different software. They'd have to relearn everything. Their years of practice skill, their efficient workflow, gone. They might struggle to even open or convert their old project files reliably.
That sounds painful.
It is. And for the studio, the switching costs are astronomical. Retraining the entire staff, disrupting ongoing projects, figuring out how to handle maybe a decade or more of archived files in Adobe formats.
Yeah, it's not happening.
The combined pain point is just so high that the annual Creative Cloud subscription effectively becomes a non-discretionary business expense, a cost of doing business. That's the lock-in the memo describes.
That really paints a picture. But The memo doesn't say the moat is perfect, right? It talks about it being stratified. What does that mean?
Yeah, this is a really important nuance they bring up. It means the fortress isn't equally strong on all sides. The analysis finds the moat is stable and actively widening at its high-value core, the professional users, large enterprises.
Okay, the core is strong, even widening.
But it has been successfully breached and is narrowing at its lower-value peripheral edges.
All right, let's break that down. How is the core getting stronger? What's widening it?
The memo points directly to the deep integration of generative AI capabilities. Things like Firefly and Sensei AI, built right into flagship products like Photoshop and Illustrator.
How does that help the moat?
Well, first, these features genuinely boost productivity for existing pros, making the tools even stickier. But here's the critical part, the moat widening part, according to the memo. Adobe's AI is trained primarily on its own licensed Adobe stock content and other legally clear, commercially safe assets.
Okay. Why is that so important?
Because it allows Adobe to offer legal indemnification to its enterprise customers against potential copyright claims arising from AI-generated content.
Ah, so if a company uses Firefly to make an image, Adobe basically says, we've got your back legally.
Exactly. For large corporations terrified of intellectual property lawsuits, and they are this commercially safe, AI is a massive strategic differentiator. Competitors who might have trained their AI by scraping data from all over the internet often can't offer that same level of assurance.
Got it. So that strengthens the lock-in for the big, valuable corporate clients.
Precisely. The memo sees this as solidifying their leadership there. And it notes Adobe's dominant market share in core creative areas like over 80% for Photoshop, around 80% for the overall Creative Cloud, reflects this core strength.
Okay, so the core is solid, maybe even getting stronger with this safe AI angle. Where is the moat narrowing then? Where have they been breached?
The memo identifies two specific areas where competitors have really gained ground. First, the consumer and prosumer market.
Meaning like hobbyists, small businesses.
Exactly. People who need to create graphics or simple designs but aren't trained professionals. Competitors like Canva have absolutely excelled here.
Canva's huge now.
It is. Because it's template-driven, incredibly easy to use, generally more affordable, and web-based. It's perfect for someone who needs, say, a social media graphic quickly and doesn't know Photoshop. Adobe, historically, didn't serve this market as well, and Canva just stepped in and captured significant share.
Okay, so Canva on the low end, what's the other area?
The other is a very specific professional niche, the UI/UX design vertical. User interface, user experience design for apps and websites.
Right, and Figma.
Figma completely dominated this space. The memo estimates Figma won something like 80-90% market share, primarily because its real-time collaboration features were just far superior for teams working on design systems.
And Adobe's own tool, XD.
The memo views Adobe XD as having become largely irrelevant in that fight, and the fact that Adobe basically stopped investing in and selling XD after their attempt to buy Figma was blocked by regulators. The memo sees that as confirmation that Adobe lost this battle organically. They couldn't compete effectively.
I think the memo even had a table showing this, right? Dominance here, losing there.
Yes. It quantifies the landscape. Shows Adobe's continued dominance in professional photo editing, video editing, vector graphics, but clearly losing in UI/UX to Figma and facing real pressure in consumer and small business graphic design from Canva.
So the key takeaway from a moat discussion is threats are real, but mainly on the edges.
That's the memo's conclusion here. The competitive threats have definitely impacted specific, often lower margin adjacent markets. But the vast bulk of Adobe's profits and cash flow, still generated by that core professional and enterprise market where the moat remains exceptionally strong and potentially even widening thanks to that commercially safe AI strategy for enterprises.
Okay, let's shift gears a bit. The memo also looks beyond just the products and the business structure to the people involved, customers and employees, and it finds what it calls a stark and important dichotomy. What's that about?
Yeah, it's basically describing a classic love-hate relationship, specifically with the customers.
Yeah.
Well, the products themselves. The memo says they are almost universally loved and revered, described as best in class, indispensable. Creative professionals often have a genuine affection for tools like Photoshop or Premiere Pro because they're so powerful, they enable their work, and they are the industry standard.
Their status there too.
Okay, love the products, but the relationship with the company, with Adobe itself, is different.
That's where the tolerated out of necessity rather than embraced part comes in, according to the memo. The single biggest source of customer frustration highlighted is the cost, the high price, and the often inflexible nature of the subscription model.
Especially for individuals or small shops, right? People missing the old perpetual license option.
And exactly. That comes up a lot. They feel locked into paying high fees year after year.
And I've definitely heard complaints over the years about customer service experiences with Adobe. The memo notes significant anecdotal evidence of that. It uses phrases like deeply frustrating support experiences. People mention long wait times, difficulty getting issues actually resolved, sometimes unhelpful support agents.
Right.
All contributing to this perception that Adobe, because of its dominant market position and high switching costs, feels somewhat insulated from its customer base. Like they don't have to provide great service because where else are you going to go? The memo even tries to quantify this a bit. It mentions a Net Promoter Score, or NPS, of plus 25.
NPS, that measures customer loyalty, right, is plus 25 good?
Well, it's positive, which means more customers are promoters, they'd recommend Adobe, than detractors.
Yeah.
But the memo stresses it significantly trails behind peers like Apple, which might be around plus 48, or even Salesforce at plus 35.
Okay, so positive, but not great compared to other tech leaders.
Right. It's seen as evidence that while customers use and maybe even love the products and are locked in by those switching costs, the actual relationship with the company itself is often strained, more transactional. The memo calls this customer satisfaction debt.
Customer satisfaction debt. Interesting phrase. Okay, so that's the customer side. Loved product, tolerated company. How does that contrast with the employee perspective described in the memo?
Well, here, the picture is completely different. The employee culture and satisfaction are highlighted as a significant and durable asset for Adobe.
Really? How so?
Adobe consistently ranks as a top employer. It scores very highly on employee satisfaction surveys. The memo mentions a 4.2 out of 5 on Glassdoor, for instance.
What makes it a good place to work, according to the analysis?
The memo points to their Adobe for All culture, which emphasizes values like being genuine, exceptional, innovative, and involved. It cites examples like progressive employee policies, things like pay parity, strong benefits, focus on well-being, and programs designed to foster innovation.
Like the Kickbox thing.
Exactly. The famous Kickbox initiative, where they literally give employees $1,000 in a red box to go explore any new idea they have, no bureaucratic hurdles. That kind of thing fosters a real sense of empowerment and innovation from within. And the memo explicitly connects these two sides, the customer and the employee.
How?
It argues that this vibrant, innovative employee culture is actually key to developing the best-in-class products. That innovation makes the products indispensable, which in turn creates the strong switching cost moat. But, the memo suggests, Adobe then leverages the power granted by that moat to charge premium prices and perhaps deliver what customers often perceive as frustrating or subpar service.
So the high switching costs basically let them get away with accumulating that customer satisfaction debt. At least for now.
That's exactly the dynamic described.
Right.
Customers might complain, but they keep paying because switching is just too painful or impractical. But the memo flags this. It warns that this customer satisfaction debt is a latent risk.
A risk how?
It creates an opening, an incentive for a competitor to emerge. Maybe not with a product that's quite as powerful as Adobe's yet, but one that's good enough and comes with a far superior customer experience, a friendlier business model. That can start to chip away at Adobe's customer base over the long term, especially if Adobe doesn't address those service frustrations. It's identified as a key vulnerability to keep an eye on. Maybe so, you can't have an enduring, high-quality company without quality leadership, right? So the memo turns its focus to Adobe's management team and specifically highlights the CEO, Shantanu Narayen.
Right. What's the memo's take on his leadership? How is he viewed in this analysis?
He's described in really positive terms as an exceptional, long-term oriented capital steward.
Long-term oriented. How long has he been CEO?
Over 17 years now. So incredible stability and vision. The memo notes his consistent leadership philosophy seems built on 3 pillars. Relentless product innovation, investing heavily in building long-term technology platforms, and, perhaps ironically, given a customer service point, a deep focus on the customer. He's viewed as someone building for enduring value, not just managing quarter to quarter.
And what does the memo pinpoint as his single biggest, most impactful achievement?
Without a doubt, it credits him with leading that strategic and perilous transformation to the cloud-based subscription model starting back around 2013.
The pivot again.
Yes. It was absolutely critical. It faced considerable criticism and user pushback at the time, but the memo argues he foresaw where the industry was heading and had the conviction, the foresight, to see it through. It fundamentally reshaped the business into the much more resilient, predictable, and profitable entity we see today. He gets huge credit for that.
Okay, strong praise for the CEO. What about how they spend the company's money? Capital allocation. That tells you a lot about priorities.
The memo describes their approach here as clear, rational, and very shareholder-friendly. It lays out a clear hierarchy of priorities.
What's number one?
Absolute first priority. Reinvesting heavily back into the core business. Funding innovation, strengthening that moat. They spend a significant amount on R&D.
You mentioned over 18% earlier?
Yes, over 18% of revenue just in the first half of 2025. And right now, a huge chunk of that is focused on integrating AI capabilities across the board. The memo views this as a highly rational, necessary use of capital.
Okay, reinvestment first. Then what?
Second, they use strategic acquisitions, typically described as bolt-ons, not massive transformative deals usually. Think of acquiring companies like Omniture back in the day, or more recently Magento and Marketo.
Why those deals?
Usually to enter adjacent market segments or acquire specific technologies, expanding their overall addressable market and capabilities, especially in that digital experience segment.
Makes sense. And finally, what happens with leftover cash?
How they return cash to shareholders is very straightforward. No dividends since 2005. Instead, they return virtually all excess free cash flow through aggressive share repurchases.
Buying back their own stock.
Exactly. The memo notes they bought back 8.6 million shares just in the second quarter of 2025. And importantly, in March 2024, they authorized a huge new $25 billion share buyback program set to run through 2028. That's a massive commitment to returning capital.
Now, the memo uses the whole saga with the terminated Figma acquisition as a kind of a rationality test for management. How does that work? How is failing to buy Figma a sign of rationality?
Yeah, it's presented as this powerful, almost paradoxical case study in their discipline. Here's how the memo frames it. Back in 2022, management correctly identified they were losing the crucial UI/UX market to Figma. So they made a very bold, very expensive $20 billion offer to acquire them. A huge bet.
Right, I remember that deal.
But here's the key point. When it became crystal clear that regulators around the world in the UK, the EU, the US, were lining up to block the deal on antitrust grounds, what did Adobe do?
They fought it.
No. They didn't dig in for a protracted, costly, ego-driven legal battle they were likely to lose. The memo highlights that they rationally assessed the situation, saw the writing on the wall, and chose to terminate the agreement. They paid Figma the agreed-upon $1 billion breakup fee and immediately pivoted.
Pivoted to what? What did they do right after killing the deal?
They announced that massive $25 billion share repurchase program we just talked about, basically right on the heels of the termination. The memo praises this sequence highly. It shows, in their view, a clear, unemotional capital allocation framework in action. Priority 1. Invest in high-return opportunities, including potentially large M&A if it makes strategic sense and is feasible. Priority 2. If those paths are blocked or don't offer compelling returns, return the capital directly to the owners, the shareholders, via buybacks. It's seen as disciplined, non-empire-building behavior.
Very rational.
And all these qualitative strengths, the business model, the moat, the management, according to the memo, they are quantitatively confirmed when you look at Adobe's actual financial profile. The memo labels the financials truly exceptional.
Okay, so what does that exceptional financial picture look like in numbers? What stands out?
Well, first, it's described as just a remarkably reliable earnings machine. That high-margin subscription model we discussed, it provides incredibly visible, predictable revenue streams year after year.
Right, less lumpy than selling licenses.
Exactly. And when you combine that predictability with those high gross and operating margins and relatively low capital expenditure needs to maintain the business, it just translates directly into substantial, consistent profitability and, importantly, cash flow generation.
We mentioned the margins. 88, 89% gross, mid-30s operating.
Consistently in those ranges, yes. And what's also impressive, the memo notes, is that even at their massive scale now, over $21 billion in annual revenue, they are still managing to deliver double-digit top-line growth.
So, still growing strongly. What specific financial ratios does the memo highlight as signs of quality?
It focuses on a few key ones. The first is return on invested capital, or ROIC.
ROIC, that's a big one for quality investors, right?
It really is. It's arguably the best single measure of how effectively a company uses the capital invested in its business, both debt and equity, to generate profits. A high ROIC, especially when consistently above the company's cost of capital, is often seen as direct evidence of a strong economic moat.
And Adobe's ROIC?
Elite performance, according to the memo. It shows Adobe consistently produces ROIC far, far in excess of its likely cost of capital. It's been running in the mid to high 20% range for years, and the memo notes it was over 31% on a trailing 12-month basis recently. That's truly top tier.
Okay, exceptional ROIC. What else?
Another key metric highlighted is free cash flow conversion. Adobe is called a prodigious generator of cash.
Meaning they turn their accounting profits into actual cash really well.
Exactly. They have an incredibly high ability to convert their reported net income into actual free cash flow, the cash left over after all operating expenses and capital investments. The memo mentions their free cash flow, or FCF, margin was around 37% in fiscal year 2024.
Why is that important?
High FCF conversion signals that the company's reported earnings are very high quality. They don't require massive ongoing capital spending just to stand still, or lots of accounting adjustments to look good. The cash is really hitting the bank account.
Got it. High ROIC, great cash conversion. Anything else on the financials?
And finally, the memo points to their balance sheet strength. It calls it a veritable fortress, providing a really wide margin of safety.
How so? Lots of cash, low debt.
Exactly. They manage their capital structure very prudently. The memo notes they held a net cash position, meaning more cash than debt, of about $3.7 billion as of November 2024. That was roughly $7.9 billion in cash and equivalents versus only about $4.2 billion in total debt. Their leverage ratios are consequently extremely low. Net debt to EBITDA is actually negative, and total debt to equity is a very conservative 0.43. Basically, very little financial risk here.
And I think the memo included a table showing these metrics over time, just showing the consistency.
Yes, exactly. It lays out about a decade of these key numbers: revenue growth, margins, FCF, ROIC, leverage, just to demonstrate how consistently excellent Adobe's financial performance has been, especially since that subscription pivot.
It's really the quantitative proof backing up all the qualitative points about the business model, the moat, and the management quality that the memo made earlier.
That's precisely how the memo presents it. The numbers reflect the underlying quality.
Okay, so let's bring it all together. We have this picture from the memo. High-quality business, strong core moat, even widening, praised management team making rational decisions, and truly exceptional financials. What does this analysis then say about the price, the valuation of Adobe stock?
Well, as of the time the memo was analyzing things, which was around mid-June 2025, it notes that the stock was trading at valuation multiples. They suggest a fair degree of market skepticism.
Skepticism? What kind of multiples are we talking about?
The trailing 12-month price-to-earnings ratio, the TTM/PE, was sitting around 26 to 27 times earnings. And the trailing 12 months price-to-free cash flow, TTM/PFCF, was approximately 19 to 21 times cash flow.
Okay, 26 times earnings, 20 times free cash flow. Now, is that typical for Adobe? Does the memo say that's where it usually trades?
No, absolutely not. The memo really stresses that these current multiples represent a significant departure from Adobe's historical valuation range.
How significant?
Historically, looking back over the previous 5 years or so, Adobe's average PE ratio had been much, much higher, typically in the 45 to 50 times range. And its average PFCF multiple has also consistently traded much higher, usually between 30 and 40 times.
Wow. Okay. So current multiples are way below the historical average. Given the quality the memo describes, is the judgment then that the current price is attractive?
Yes, that's the conclusion. Based on their deep analysis of the business's enduring quality, the formidable strength and even widening nature of that core moat, and the rational shareholder-focused management team, the memo deems the valuation at that time an attractive entry point for a long-term investor.
A long-term investor. Okay, so why is the market skeptical right now, according to the memo? What's causing those lower-than-average multiples if the quality is so high?
The memo attributes the market's current skepticism primarily to near-term concerns. Two main things seem to be weighing on the stock's valuation. First, uncertainty about the exact timeline for Adobe's big AI initiatives to start generating meaningful new revenue. People see the investment cost, but the timing and magnitude of the payoff feels less certain right now.
Okay, AI timing uncertainty, what's the second thing?
The second is the persistent competitive narrative, especially the noise around Canva and Figma. Even if, as the memo argues, that competition is mainly impacting the periphery, the story of disruption is clearly influencing market sentiment and keeping the valuation multiple compressed compared to history. And the memo explicitly frames this for the reader. For an investor who has a truly long time horizon, someone thinking in terms of decades, not just the next few quarters, this apparent disconnect between what the memo views as temporary, short-term uncertainty and the business's demonstrable, enduring long-term quality. Well, that disconnect is precisely what creates a compelling investment opportunity.
Right. The thesis doesn't need the stock to go right back to those sky-high historical multiples to work out well.
Exactly. It just needs the business to keep executing and compounding its value over time, which the memo seems confident it can do.
So, looking ahead then, where does the memo see future growth actually coming from for Adobe? What are the key drivers?
The single most important growth driver identified in the analysis is the successful integration and, critically, the monetization of generative AI capabilities across their entire product portfolio.
Monetization. Making money from AI.
Right. This isn't just seen as a defensive move to protect the existing business. The memo views AI as a major offensive growth strategy for Adobe.
Okay, so how exactly does AI drive new growth, according to this analysis? What are the mechanisms?
It points to three distinct ways AI is expected to fuel growth. First, through upselling and increasing average revenue per user, or ARPU.
How?
By embedding powerful new AI features like the Firefly image generation or the Acrobat AI assistant that summarizes PDFs directly into higher-priced subscription tiers, like Creative Cloud Pro plans. This creates a clear path, a reason for existing users to upgrade and pay Adobe more money each month or year.
Okay, get existing users to pay more. What's the second way?
Second, through new user acquisition and overall market expansion.
How does AI bring in new users?
Think about it. Generative AI dramatically lowers the technical skill barrier required to create high-quality digital content. The memo believes this can significantly expand Adobe's total addressable market to potentially millions of business professionals and consumers, people who aren't trained designers or video editors, but still need to produce presentations, reports, social media posts, simple videos. AI makes Adobe's powerful underlying tools suddenly accessible and useful to them.
Right, makes it easier for non-pros. Got it. And the third way AI drives growth?
The third way is by solidifying enterprise leadership. We touched on this when talking about the Moat widening.
The commercially safe AI part.
Exactly. That aspect, training Firefly on licensed content and offering legal indemnification, is seen as a huge strategic advantage for winning and retaining large, risk-averse enterprise customers. For corporations deeply concerned about intellectual property risk, Adobe provides a crucial safe harbor. The memo believes this will drive adoption in the highest value segment of the market and allow Adobe to maintain premium pricing there, capturing a disproportionate share of the enterprise AI spending. So, significant growth potential, especially from AI. But the memo is careful to stress that investors need to remain vigilant about potential permanent impairment risks.
Permanent impairment, you mean existential threats, things that could really break the business model for good.
That's exactly what it means. Threats that could permanently damage the long-term value proposition and profitability.
Okay, what are the top three most significant permanent risks that the memo calls out?
First, and the memo presents this as arguably the biggest, most fundamental long-term threat, is AI-driven commoditization.
Commoditization, meaning AI makes creativity cheap or easy.
Essentially, yes. This is the nightmare scenario. What if AI becomes so incredibly powerful, so capable, that it can genuinely produce truly professional-grade creative work? Photorealistic images, broadcast quality video, complex designs directly from very simple natural language prompts.
Okay.
In that world, the need for highly skilled human operators spending years mastering complex software like Photoshop or After Effects could be dramatically reduced, maybe even eliminated for many tasks. That would fundamentally undermine the value proposition of Adobe's core products. It could commoditize the entire creative process and permanently impair Adobe's business model, which is built on the value of that complex software and the skills needed to use it.
Wow, okay, that's a big one. What's the second major risk?
The second risk highlighted is the ongoing erosion of pricing power from good enough competitors.
Like Canva and Figma we talked about.
Exactly. Plus potentially other emerging AI-native tools. The memo acknowledges the persistent pressure from these often more affordable, easier-to-use alternatives. If these good enough tools continue to improve and satisfy the needs of a larger and larger segment of the market, maybe even starting to peel off some less demanding professional users, Adobe could eventually be forced to compete more directly on price.
Which would hurt those amazing margins.
Precisely. It could significantly damage their historically high margin structure.
Okay, AI, commoditization, price erosion. What's the third major risk?
And the third is simply failure to innovate and execution risk.
Meaning Adobe messes up.
Right. As the clear market leader, Adobe is the one everyone is shooting at. The AI landscape is evolving incredibly rapidly. The memo warns that Adobe must constantly innovate and successfully execute its strategy for integrating and crucially monetizing AI. If they stumble, if they fail to deliver compelling AI features or find the right business models for them, more agile or focused competitors could potentially leapfrog them and capture the future of creative tooling, leading to a slow but potentially irreversible decline in Adobe's market position.
Makes sense. You have to keep running fast just to stay ahead. Now, the analysis also includes something called a second-level thinking inquiry and a red team challenge to really pressure test the whole investment thesis. Before we get to the challenge part, what's the memo's read on the general market sentiment towards Adobe right now? What's the consensus view it's pushing against?
It describes the prevailing market view, often summarized by a moderate buy consensus rating from analysts, as one of, let's call it, cautious optimism, but heavily weighted toward the cautious side.
Cautious.
The market clearly acknowledges Adobe is a high-quality company. That's not really debated. But this acknowledgement is heavily tempered by significant near-term skepticism. We touched on the reasons. Persistent worries about the competitive landscape, Canva, Figma, genuine uncertainty about how quickly or how successfully Adobe can actually make money from its big AI investments.
People see the cost of AI R&D, but the revenue feels further out.
Exactly. Many in the market seem to view Adobe's AI spending more as a costly defensive necessity rather than a guaranteed offensive growth driver, at least in the near term. And there's also a perception, rightly or wrongly, of some deceleration in their core growth rate compared to the past hypergrowth years.
And the memo even notes how the stock sometimes falls even after reporting pretty good earnings numbers. That's a sign of this underlying skepticism, right?
Yes, it sees that kind of price action beating expectations but still selling off as a direct manifestation of this skeptical narrative. Good results today, but lingering questions and doubts about the future competitive and technological environment are keeping a lid on the valuation.
Okay, so that's the somewhat skeptical consensus view. Where does the memo's contrarian view diverge? What is it arguing the market is missing or getting wrong?
The core contrarian point in the analysis is the conclusion that the market is systematically underestimating the strategic and ultimately financial importance of Adobe's commercially safe AI moat, particularly its resonance with the crucial enterprise market segment. This is really the heart of the second-level thinking presented in the memo. While much of the market conversation, the first-level thinking, focuses on comparing AI features, speeds, or pricing.
Right, like can Firefly do this cool thing that Midjourney can do?
Exactly. That's first level. The memo argues that for Adobe's most valuable, highest-paying enterprise customers, the primary considerations are often different. They are deeply focused on things like risk mitigation, security, brand safety, and, crucially, avoiding legal liability.
And Adobe's safe harbor approach with AI, training on licensed content and offering indemnity, speaks directly to those concerns.
Precisely. By training its Firefly models predominantly on its vast library of licensed Adobe stock content and other commercially cleared assets, and then backing that up with legal indemnification against copyright claims for enterprise users, Adobe provides those corporations with a crucial safe harbor in the incredibly murky and uncertain legal landscape surrounding AI-generated content.
Something competitors using web-scraped data might struggle to offer.
That's the argument. It's presented as a powerful, durable, competitive advantage that competitors who train their models on potentially unlicensed internet data cannot easily replicate. The memo firmly believes this focus on commercial safety and legal protection will be a major driver of enterprise adoption for Adobe's AI tools, allowing them to maintain premium pricing and capture the most valuable segment of the emerging AI creative market. And that, the memo argues, is the key factor the current market narrative is overlooking or significantly underappreciating.
Okay, that's a clear articulation of the contrarian view. Now, to really stress test this whole investment thesis, the memo employs a technique called a red team challenge. How does that work? What are they challenging?
They do it by taking the absolute core, fundamental assumption underlying the entire bullish investment case and deliberately inverting it, flipping it on its head to see what happens.
Okay, so what is the core assumption the bull case for Adobe rests on, especially regarding AI?
The fundamental assumption, the one driving Adobe's strategy and the optimism in the memo, is that generative AI will ultimately prove to be an augmentative technology for creative work.
Augmentative, meaning it helps humans, makes them better.
Exactly, meaning AI acts as a powerful new tool that makes skilled creative professionals more productive, more efficient, perhaps even more creative, thereby actually increasing their reliance on Adobe's sophisticated software suite, where these AI tools are embedded. In this view, AI enhances the human creator who is still using Adobe's core applications.
Okay, so AI helps the user of Adobe software. That's the bull case assumption. What's the inverted red team bear case scenario presented in the challenge?
The nightmare scenario, the inversion is, what if AI proves to be a fundamentally substitutive technology rather than augmentative?
Substitutive, meaning it replaces the human or the need for a complex software.
Precisely. Imagine a world maybe 5 or 10 years down the road where an AI model becomes so powerful that it can genuinely produce truly professional-grade output video, images, graphics, layouts directly from a simple text or voice prompt with minimal human intervention or refinement needed.
So the user isn't a skilled operator anymore.
In that future, the primary user isn't a skilled operator mastering complex software tools. They're more like a director or a prompter, simply issuing high-level commands to an incredibly capable AI engine. The AI does the heavy lifting of creation.
And if that happens, what's the impact on Adobe's business model according to this challenge?
Catastrophic impairment. In that substitutive AI scenario, Adobe's entire business model, which is built on the value of mastering its complex software and collaborating using its proprietary file formats, is potentially rendered obsolete.
How so?
The economic moat, largely based on the high switching costs associated with mastering that complex software, it becomes irrelevant if you don't need to master the software anymore. Network effects tied to specific file formats like .psd or AI. Meaningless if the AI can output in any format needed, or if collaboration happens at the prompt level. Adobe's immense pricing power. It likely collapses as the fundamental value shifts away from the sophisticated creation software and towards the underlying generative AI model itself, which might be provided by someone else entirely.
It sounds like they'd risk becoming the world's best horse and buggy manufacturer just as the automobile is taking over.
That's precisely the analogy used in the memo's Red Team Challenge. If that substitutive future comes to pass, then the market's current skepticism about AI's impact wouldn't just be correct, it would be profoundly, dramatically understated. An investment in Adobe today, even at what looks like a historically reasonable valuation, could turn out to be a classic value trap and a major long-term mistake. The memo presents this potential for AI to be truly substitutive, not just augmentative, as the single most potent existential risk to the entire long-term investment thesis. So wrapping things up, we've taken a really deep dive into this specific internal analysis of Adobe. We've seen the picture it paints of a business built on an incredibly powerful, high-margin subscription model.
Yeah, anchored by those core products like Photoshop and Acrobat that are just undeniable industry standards.
Right, and that model is protected, particularly at its core, by significant switching costs, network effects, and valuable intangible assets like their brand.
Which all translates into those truly exceptional financial characteristics. The memo highlighted the high margins, that incredible ROIC, the prodigious free cash flow generation, all supported by a rock-solid fortress balance sheet.
We also looked at the leadership, particularly CEO Shantanu Narayen, who the memo praises for his long-term vision and rational capital allocation decisions.
Including that really telling disciplined pivot away from the blocked Figma acquisition and immediately towards that massive share buyback program, showed a clear framework.
We explored the significant potential the memo sees for generative AI to be a major future growth engine. Not just defensively, but offensively.
Right. By driving upselling to existing users, expanding the market to new types of users, and critically solidifying their leadership with large enterprises who value that commercially safe AI approach and the legal indemnification that comes with it.
And of course, we considered the risks laid out in the analysis. The threats from competitors like Canva and Figma gaining traction on the edges, the potential for pricing power to erode over time, and the constant need for Adobe to innovate and execute flawlessly in the face of rapid technological change.
But towering above those, we really dug into that single most significant long-term existential question raised by the Red Team Challenge.
Could AI evolve beyond being just an augmentative tool that makes creative professionals more reliant on Adobe? into a truly substitutive force that fundamentally changes the creative landscape and makes the need for mastering complex creative software itself less important or even obsolete?
So the memo ultimately concludes that despite the market's current skepticism about near-term AI monetization and competitive noise, the demonstrated enduring quality of the business, combined with its valuation at the time, makes it look like an attractive entry point for a long-term investor.
But it very deliberately leaves you, the listener, with that provocative final thought. It really asks you to consider which future you believe is more probable. Is AI simply going to make creative professionals faster and better using Adobe tools, thereby strengthening Adobe's position?
Or is there a real possibility that AI could eventually make the need for those complex creative skills and the sophisticated software that caters to them fundamentally less important?
That's the key question the analysis ultimately poses. Something for you to continue mulling over, building on the detailed picture this deep dive into the source material has hopefully provided.